portfolio theory explains how investors can combine different assets to minimize risks, to minimize risk for a given level of return, or maximize return for a given level of risk. Portfolio theory explains how investors can combine different assets to minimize the risk for a given level of return, or to maximize return, to maximize return for a given level of risk. So here, portfolio, you're not looking at only one asset. You're not looking at one investment. If you're looking at the assets, call it even in the investments. You are not looking at one asset. You're not looking at two. You are not looking at one investment. You want to see if you combine. If you combine your investments, are you likely to minimize the risk for a given level of your return, or are you likely to maximize the return for a given level of risk? So that is the portfolio theory. The idea is that risk should not be analyzed at the level of individual investments, but at the level of the entire portfolio. You are not analyzing, when you're talking about portfolio, you are not analyzing the risk. You are not analyzing only one investment. You are looking at basically the whole portfolio, the whole investment. If you have investment A and B, you are analyzing the whole of it. Okay, so if you are an investor, you want to combine those two investments and see whether you can be in a position to minimize risk. All you need to know is that, of course, these are assets or these investments. They behave differently under economic conditions. And of course, when it comes to portfolio, you have to look at issues related. You are trying to diversify. You are trying. It basically this theory focuses on diversification. It focuses on the correlation between the investments. The capital market line. Those things can apply here, but of course, for exam purposes, for us, maybe if you to explain the portfolio theory, this is what you can put. This is what you can put. You are looking at more than one investment, more than one asset. You as an investor, if you combine two assets, if you combine two investments, if you combine three investments, are you likely to minimize risk? Are you likely to maximize return? Okay. Then a portfolio analysis. This portfolio analysis. The portfolio analysis. This one. The portfolio analysis. Is the practical. Just the practical application. The practical application of the theory. Now you want to apply it practically. So here it will involve, it involves the, this one involves evaluating combination of investments or securities to determine here you're determining, you could be determining one, you're determining the expected return, the expected returns of the portfolio, then you determine, you could be determining the portfolio risk, it could be about covariance, it could be about correlation, coefficient. It could be about the correlation, the coefficient of variation. So you as you evaluate your portfolio or your investments, you may need to apply any parameter. Okay, you may need to apply any parameter. We may need to apply the mean variance analysis, the mean variance approach. So we are going to discuss all this in details. What does each one mean? And how can you get each of these? If you want to get the expected return of your portfolio, if the portfolio you're looking at your investments, it could be investment A, B, C. So what do you expect as your return from that portfolio? What is the portfolio risk? If you have decided to invest in A, B, C, what is the portfolio risk? We are going to share ideas about all. But when you look at the expected return, this expected return of a portfolio, the expected return of a portfolio, in a simple way is the average return. The average return you expect to earn from the whole portfolio, based on how much you invested, you invested in each asset or in each investment. That is expected return of a portfolio. So if you put more money in an investment that pays higher returns, the portfolio's expected return will also be high. If you invest your money in an asset that pays more, also the expected return of the portfolio is likely to be what? Is likely to be high. Okay, so for example, okay, we are going to do this practically, but you are going to see that the expected return of a portfolio, will be equal to, you look at each investment separately. what portion did you invest in? What portion did you invest in A? If you invested 60 in A, multiply it by its return, expected return of A. If you invested in A, what do you expect from A as the return? You will have to compute that. Then plus, if you invested, let's say 40, of course, if you invest 60, the other side, you are going to invest 40. So it could be 40 times what? 40 times expected return of investment B. What you expect from your investment B. That's how we compute the expected return of a portfolio. If you have 2 investments, if you have 3 investments, you go ahead and add. You go ahead and add that one. You need to know what portion did you invest? What portion did you invest in a project? Did you invest 60? Did you invest 40? If the examiner has not given you the portion, then you can use the average, equal. You can say that it was on assumption that what was invested is on equal basis. If you're looking at 3 investments, then of course there it will be on equal basis as well. But of course, as we deal with these questions, a portfolio for exam purposes, you're going to be looking at only two investments to make a portfolio for exam purposes. For exam purposes. You're not going to find that you're looking at A, B, C at the same time. For exam purposes, you're going to focus on only what? 2 investments. 2 investments, A and B, or A and C, then A and D, depending, but focus on only 2. Okay, that is expected. That is expected return of a portfolio. That is expected return of a portfolio. Now, how do you get this? Is also very, very key, because there we will need to know now. How do you get expected return of let's say A? For me to get expected return of A, then I will be getting my probability from the question. This will be the summation. It will be the summation of the probability. Here you get the probability. Probability times the returns of A. The returns of A based on the what? Based on the market conditions. We are going to say that you may be operating in an economy where you have low, moderate, and high. So what is the probability if the economy is the market economy is low? What is the probability when the market economy is moderate, or when the market economy is high? So we'll be having that. But that's how you get the expected return. That's how you get the expected return. Okay, that's how you get the expected return. If you're looking at B, where there is A, you remove A and put B. Okay. Here you are looking at the individual. Here you are looking at the individual asset. You are looking at only one asset at a time. This is for only one, for only one asset. As you get the expected return of a portfolio, you combine. Okay. We are going to see that. Please take note. Now, then what is the risk of a portfolio now? What is the risk of a portfolio? What is the risk? Risk of the portfolio risk of a portfolio. Risk of a portfolio. This one means what? Risk of a portfolio simply is when we are talking about risk, is just the uncertainty. Is the uncertainty in the returns. In the returns, you expect from the portfolio, just uncertainty in the returns you expect from the portfolio. Always know that in finance, the risk is how much your actual return here. What we are talking about here, it could be like how much. This is like how much your actual return, how much your actual return may differ from the expected return. If you want to get it clearly, you expected some return, but of course the actual return may be different from what? May be different from the expected one. And what is the reason? That is the uncertainty there. That is the uncertainty. The movement in these two is the risk. If you expect, let's say, 10% return, you may get, let's say, you may find that you expected 10% return, but in actual sense, you get let's say 20, rather 2. You may be expecting 10%, you end up getting 2, or you end up getting 18. So just the movement is the risk. The movement is the what? The movement is the risk. The more unpredictability of the investment, the greater the portfolio risk. If it is hard for you to predict how you're going to earn, then it becomes a risk to your case. So the risk will always also depend here. It will always also depend on. It also depends. Just I know you may be having these things. It also depends on how much, on how. It also depends on how the returns, on how the returns of the different investments move together. That is, we are going to look at the correlation. Now, if you realize that these investments, these returns move in the same direction, the risk will always be high. The risk will always be high. What if you don't perform? What if there is some issue in that industry? It means that all your investments may be affected. So if you realize that these investments move in the same direction, then the risk can be what? Can be high. Okay, so that is about what? That is about the risk of a portfolio. And we have a formula that we use when you're looking at the risk of a portfolio. Now, a formula that we use when you look at it, I'm going to discuss a question, but of course, the formula will always be given. The formula will always be given. From your formula sheet, you'll always be having that formula, that formula in our exam. I don't know whether it is visible enough. Is it visible enough?
Yes.
So that is our formula. That is our formula that we use when we are determining the risk of a portfolio. This is the proportion of what percentage did you invest? If you invested 60% of your money, That is the proportion. Then S squared is variance. This is variance. So if you have standard deviation, you square it. But if you have variance, S squared is simply the variance of A. Then plus we look at another investment B. What did you invest in B? If you invested 40, that will be 0.4 squared. Okay. Then times the variance of B plus 2 times what you invested in A times what you invested in B, like 0.6 times 0.4 times this is, we are going to look at this. This is the correlation coefficient. Correlation coefficient. Now we are going to see that in some other scenarios, we are going to see that instead of using correlation coefficient, we can use another another formula where you have correlation coefficient RAB times, this is RAB is correlation coefficient times the standard deviation of A times standard deviation of B. But I want you also write in your book that I can decide to remove all this. I can decide to remove you can decide to remove this RAB times SA times SB and just you put covariance, and that becomes very, very easy. That becomes very, very easy. We are going to see that. So you please note that. I think I have explained a bit of risk. Then you need also to understand, understand what is covariance, because like the way I listed, it is good not just rush for you to do the computations, but you need also to understand these things. What is covariance? What is covariance? As we look forward to do the computation, what is the covariance of a portfolio? Covariance of a portfolio. What is the covariance of a portfolio? What is the covariance of a portfolio? This simply shows, in simple terms, this shows how investments move together. It just shows how two investments move together. Okay. Do your investments move in the same direction? So here, if both investments go up together, or go down together, then it means that here your covariance will be positive. Okay, if they move in the same direction. If they are to go up, if they are to increase, they all increase. They go up. If they are to go down, let's say, if they are to go down, or you find that they are performing bad, like just look at this in terms of the performance. If the performance in A is high, we expect that also the performance in B should be high. For the covariance to be positive. Okay, or must be high. The performance must be high, or they move in the same direction. If they don't, if all perform well, if we find that the performance is not good, the investment in A, we expect that also the investment in B, the performance is not good, or are in the same or they move in the same direction. When the performance is bad, the other side, also the other side is not good. Okay. When the performance is good, in investment A, also the performance in B is good. There, the covariance is positive. The covariance is positive. Okay. Then, if you realize that if one investment, let's say if one goes up, when the other falls, then here the covariance is what? The covariance is negative. What does this one mean? For example, your performance in A is good. Okay? Investment in A is performing well. But investment in B, your investment in B is not performing well. They are moving in different directions. The other one is performing well, but the other side, the investment is not doing well. So there you have a negative covariance. And when you're recommending on which portfolio to undertake, you actually recommend the management to undertake the portfolio with negative covariance. Why? Because we want to minimize what? We want to minimize risk. So that in case one investment is not performing well, I can compensate. I can compensate it with what I have received from the other investment. Just imagine all investments are not doing well, are not performing well. What will happen? You're risking your life, you're risking your money. That's why we advise the management to undertake a portfolio with negative covariance, so that in case one investment is not performing well, then it can be compensated by the money received from what? From the other investments, which is doing well. But if all are doing bad, are not doing well, then it becomes so risky. Okay? That's why when we are explaining the risk, when we are explaining the risk of a portfolio, the risk of a portfolio depends on how the returns of the different investments move together. How do they move together? If you realize that they move together, then it becomes what? It becomes tricky. It becomes tricky. We normally go with the negative covariance. Okay, then next, now we have a formula when you're looking at covariance. Do you know the formula? The covariance of a portfolio is equal to what? Do you know the formula? This is the formula. This is the formula. In short, you're getting the probability times the deviation. This is what you see here in bracket is the deviation. The deviation. This is the return of A. The return of A minus mean of A minus expected return of A. This is just the return, but this is the expected return, or what we call mean. Okay? So x minus x bar is like the deviation. We are going to do that practically. Okay? All right. Then what else? What else? We need to look at the correlation coefficient. What does the correlation coefficient mean? What does correlation coefficient mean? Now, correlation coefficient, this one now looks at, you see here, you don't know, it just shows whether the investments move together. The covariance just shows how two investments move together. But here, when it comes to the correlation coefficient, it will tell, it measures how strongly how strongly two assets, two investments move together, move together, move together. Let me hope you understand this. Correlation coefficient tells you how strong. This one will just tell you, will just show you that these two investments move together or they don't move together, okay? But this one will show you to what extent, to what extent. So correlation coefficient will show you to what extent, to what extent do these two investments move together. So it will be it shows how strong the two investments move together on a scale from, it could be, let's say, -1 to +1. If you realize that you have an answer which is positive, this one will show that two investments move exactly in the same direction, in the same direction. Okay, then if you have 0, it will show you that there is no relationship. Now then you have, let's say, -1. That one can show you that move exactly in opposite direction, in opposite directions. Your two assets or two investments will be moving in opposite direction. Now, just imagine you have, now you will be if let's say you have positive 0.8, anything that is above 0.5, anything that is, let's say it is 0.8. 0.8 will show you that they moved, the assets move, the two assets move. If let's say you have 0.8, it will show you that your assets move strongly in the same direction. Okay. If you have, let's say, -4, it will show you that those ones, of course, you will need to know how the language. The language you can use strong, you can use moderate, you can use weak. Okay, depending on how you want to explain, depending on how you want to explain, But as long as your answer is negative, just know that your assets move in opposite direction. And we always recommend the management to invest in a portfolio with negative correlation coefficient. That the one that has a stronger negative correlation coefficient, the stronger negative coefficient is better. Stronger negative correlation coefficient is better. Where you have a higher negative, you recommend the company to invest in that portfolio. Okay. All right, so we are going to see now here the formula. The formula is also given when you look at your the August paper 2025. It was like here, you see you have correlation coefficient, the formula. You get the covariance of your portfolio over standard deviation of, this is standard deviation of investment X times standard deviation of investment Y. Standard deviation is like risk of A alone or risk of X alone times risk of Y alone. We are going to see how you get the risk. Have you noted that down in your books?
Yeah.
That is how we get the correlation coefficient. Okay? And I believe now you have the hint that if you are computing if you have, let's say, 3 portfolios, you have the correlation coefficient for all the portfolios, for all the 3 portfolios. Then look at the one with stronger negative, the one with the higher negative correlation coefficient is the one which you should recommend the management to undertake. Okay?
Okay.
All right. Then what else? What else? You need to understand what is the correlation coefficient. What is correlation coefficient? What is correlation? What is correlation? What is correlation coefficient? Put it that this one measures the risk per unit of the return, per unit of return. Coefficient of variation measures risk per unit of return. How much this one is how much coefficient of variation answers questions like how much risk am I taking? How much risk am I taking to earn, let's say, 1% of return? If you want to answer that question, you need to determine the coefficient of variation. The coefficient of variation. Now, it means that when you want coefficient of variation, then you will simply be getting the coefficient of variation will be equal to the standard deviation. The standard deviation divided by what? Divided by the expected return of a portfolio. The risk of a portfolio here, it is a risk of a portfolio divided by expected return of a portfolio. In that way, you'll be in a position to know your coefficient of variation. Which one is better, the high or the low?
The low.
Yes, where you have the lower, if you have more than one investment, one portfolio, the one with the lower CV is better. The one with lower CV is better. Okay, if you have let's say investment portfolio A with CV of 0.5 and the other one is let's say 0.8, the one of 0.5 will be better. Because it will in simple terms, you'll find that there it gives the higher return or the lower return, depending on how you're looking at it. But the lower the better. The lower the better. You always need to know how you should conclude. And now when you're dealing with these questions about portfolio, this is the one that is normally recommended to advise whether the management should invest in a portfolio. You need to always determine CV, the coefficient of variation. If the examiner has not specified the approach to use, you need to always determine the coefficient of variation. It is the method which is recommended. Okay. All right. So that is about CV. Then what about Here the portfolio with lower CV is better. Now, what the last one? The last one is the mean variance, approach. Now, with mean variance approach, basically this one describes the relationship. This describes the relationship between expected return, that is mean, and the risk, that is you look at it, could be in terms of variance or standard deviation. Okay, so we are looking at the what, the relationship between these two. Okay, always know that mostly with a higher return usually comes with what, with higher risk. That one you should know that. And lower risk. If you invest in a lower risky projects, then usually this one comes with what, with lower return. So it means that here it will be just a matter of knowing what is the risk appetite of the investor. What is the risk appetite of the investor? So if the risk appetite, if those guys are risk averse, finding that those guys don't like taking risk, then you will go with the one that gives the one with lower risk and lower return. Okay, then if those guys are risk takers, then for risk takers, they opt where there is higher return. For risk takers, they opt where there is higher return. It doesn't matter about the risk, whether the risk is high or what. For them, they want where there is higher return. If for them to get higher return, they need to take higher risk, they will take the higher risk. So if you are dealing with a question and you realize that the examiner has told you that this company is a risk taker, for you, your focus should be on higher return. If you are looking at two portfolios, let's say this is portfolio A, let's say this portfolio A, has a risk of let's say 10% with a return of let's say 20. Then the portfolio B, let's say let's say has a risk of so if you have something like this, and they tell you that a company is a risk taker, you recommend which portfolio? You recommend which portfolio? You recommend which portfolio?
Portfolio B.
If it's a risk taker, if he is a risk taker.
Portfolio B.
Risk taker, his aim is to earn more. Risk taker, it doesn't matter about the what? It doesn't matter about the risk. He will always choose where there is high.
The one which has a higher return.
So here the risk taker will opt for what? For B, isn't it?
B.
Because it's where we have the higher return. It's where we have the higher return. But if you realize that you have Okay, for you always focus to avoid the confusion. For you always focus on the return. If the risk is 12% and the return is 21, still you choose what? You choose B. You choose B because it's where you have what? Where you have
Chance.
higher return. You get that, eh?
Yeah.
For risk takers. But if you're dealing with the risk averse guys, for them you go with this one where you have less risk. Less risk. Okay, I think I have given you some high-level summary. All right, now we need the okay, let me hope you're making these summaries in your book. Okay, we need also to understand as we prepare for our paper. As we prepare for our paper, if you were to explain, the merits of portfolio, portfolio analysis, and you are given like 8 marks. Can you explain? Can you explain? This is a theory that is always common. Can you explain? One, it enhances the diversification. It enhances the diversification. It helps in simple terms here. The portfolio analysis helps it at spread investments across different different asset classes or sectors. In that way, if one sector is not performing well, you can earn from the other sector. That is portfolio analysis. Okay, that's why we say that you opt for an investment. You opt for investments that do not move in the same direction. So that if, let's say, you invest in an education sector, let's say you have a school, don't again another investment. Don't again invest in schools. Invest in another sector which is not education sector. You get, so that if education sector is not performing well, you can earn from portfolio analysis. Then number two, it is about what? It supports performance evaluation. Supports performance evaluation. This one helps assess how each asset, how each investment contributes to overall performance. And that one makes it easy to identify which security should be increased, reduced, or removed. Because if you realize that one of the investment is not doing well, then you may decide to reduce your investment. You may decide to remove that and opt for the other. So it supports that kind of evaluation. Also, when you're looking at the asset allocation planning, helps in what? In asset allocation planning. Asset allocation planning. Asset allocation planning. It helps in asset allocation planning. Here, this one allows what? It allows investors to determine the right mix the right mix of equities. Equities, it could be bonds, it could be cash, among others. So a good allocation will ensure that the portfolio can withstand with market securities. So it is good for you to, because here you will be knowing where can I focus, where can I focus more, where can I put my resources, where can I put my resources, okay? Let me hope it is coming out clear to you guys. Then what else?
Helps in decision making.
Helps in decision making. How?
It's easy to identify the project with the portfolio with the high return and with the risks. So you can either go with, you can decide whether to go with the one with the higher return and less risk, or you go with the one with the higher return with the higher risk. It depends on the type of risk taker you are.
That is very, 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 very correct. Yeah? That is very, very correct. Okay. Helps in the what? In the decision making. Just a minute, guys. Okay, okay. Can you hear me?
Yes.
For decision making, which one you can invest in? Which portfolio can you? Which one can you opt for? It will help you to know which one, which portfolio to focus on. Okay, what else? What else? So yeah, when you are explaining this point, you can say that through analysis of correlations, it could be the risk measure, the risk measure, the risk measures, and the expected return. Investors gain deeper insights. Okay, and this leads to objective decisions based on data rather than emotions. So you are making the decision based on the what? Based on the analysis. Based on the analysis. Okay.
Another one, it helps in risk management.
Okay, that is about to decision making. Then
Another one, it helps in risk management.
Risk management. We have not yet talked about risk management.
No.
Helps in risk management. Risky management. It is useful for what? Let me say it is useful for risky management. How? Okay. This one This it identifies what? It identifies risk sources. Risk sources like market, like interest rates, like inflation, and and in that way managers and this way and in this way and in this way managers or the investors will design strategies to overcome to overcome. It could be about using e.g. they can use the hedging strategies. If they realize that maybe the problem could be about the interest rate, it could be about, let's say, the exchange rate, then they can mitigate the risk by or through hedging. You can maybe also put a point of it helps identify the underperforming investment. And what does that one mean? Or how this analysis helps, it highlights what? It highlights assets whose returns do not justify the risk they add to the portfolio. To the portfolio. And in this way, what will happen is that in that way it will promote efficient portfolio structuring. Hence, and in the long run, this promotes efficient portfolio restructuring. Because if you realize that, let's say, one investment is not performing well, then you can remove it and focus on and combine it with another, or you go with another what? With another investment. Okay, I think you will add more. You know theory, you just explain, you defend yourself. Put a point and defend yourself. But also there are things of supporting the regulatory and professional standards, because you know that like these institutional investors, like pension funds, must justify their choices. Okay. It supports regulatory and professional standards. How these institutional investors look at, let's say, NSSF. If they are looking for the portfolio, like these pension funds. You cannot just invest like that. So institutional investors must justify their investments, must justify their investment choices. So this portfolio analysis will help this portfolio analysis. So portfolio analysis. This analysis will provide the documentation and We'll provide the justification. We'll provide the justification. We'll provide the justification for the decision. Like the same way you look at NPV, like justification. Like the same way you look at NPV and say that if a project is, you conclude by saying that the project is viable. Still also here, if I use my analysis, the portfolio analysis, I can justify my what? My reason for going for opting a portfolio. Okay? So it supports you. It supports you in that. Okay? Among others. It facilitates goal-based investing. Goal-based investing in a way that these investors can tailor portfolios, can tailor portfolios at specific goals. Goals could be like, for them, you may find that some guys are focusing on income, others are focusing on growth, others are focusing on capital preservations. Okay? Capital preservations. So this analysis can support you. This ensures that this ensures the portfolio aligns with the investors, financial objectives. So depending on your objective, this analysis can help you. Next, we can talk about the demerits. The demerits of this analysis, the demerits of the portfolio analysis. One we can talk about it requires accurate data. The analysis heavily depend. Okay, the analysis depends heavily on accurate historical data. And if the data is incorrect, if the data is incorrect or incomplete, the analysis becomes what? Becomes unreliable. The analysis becomes unreliable. It's one of the things that you need to know here. And also here, we need to know that we need to also know that it involves okay, it ignores what? It ignores the market anomalies. It ignores the market anomalies. What you need to know is that the market sometimes behave irrational. Irrational. Due to what? Due to speculations, due to speculation or crisis. Okay. And of course, this analysis, this portfolio, the portfolio model, portfolio model, portfolio model often fail to do what? Fail during such abnormal conditions. When such things happen, in scenarios of crisis, in scenarios of speculations, this model cannot really work. And also, it requires what? It requires when you look at the computations, there are some complex calculations. Okay. Some people may look at it as easy calculations, but of course, some people may look at it as the way we calculate those things may be complex. Okay, so it involves someone who can also look at it. Involves computing things like covariance. It involves computing. It involves computing. It involves computing covariance, calculation, deviation, and some of ordinary investors may find these computations are complicated. It's also another thing that you need to know. Something that you need also to know. Okay, then you also need to know that historical performance may not predict the future. Now, this analysis assumes past risk or returns apply in future. But markets change. So this can lead to this mislead investors. This mislead investors into wrong. That can mislead investors into wrong decisions. Whenever you're relying on the past data, you need also to know that highly likely you can end up making wrong decisions because things change. How you performed in the past are the things or the factors, the drivers may be different in the future. We may also talk about it is subject to modeling errors. How? If assumption is like risk-free things like expected returns, the ones we rely on, things like beta. If all those things, anything that you rely on are wrong, if your inputs are wrong, then the entire analysis collapses. And this may lead to poor investment outcomes. Okay, so I think that those are some of the points you can put there. It also assumes investors are rational. The theory assumes the theory assumes that these investors the theory assumes investors always act rational, but we know, but in reality, emotions affect the investment decisions. So this makes what? This makes analysis sometimes unrealistic. Okay, I think you can put some of those points. Okay. Any question? I think we have done the bit of theory. Next time we are going to do core 2 numbers calculations, and that will be all for this topic.